Billionaire philanthropist and sage Warren Buffett is undoubtedly the most successful and famous investor of his time. But he didn't build his reputation by chance. Year after year, he keeps brainstorming with the best and honing his strategies. But what if we told you his killer win streak all boils down to only 7 rules? 7 rules that, if you apply today, will keep you winning in 2024, and well, forever. So stay tuned, because in this video, we'll be breaking down all of the steps to the last letter, including where and how to apply them to your own investing. But make sure you stay till the end, as ignoring number 7 is so detrimental that even Warren Buffett himself admitted that, in doing so, he made a foolish mistake at the start of his career. With that said, let's start with his number 1 rule when it comes to investing, which is don't lose. Remember his famous quote, "The first rule of investment is don't lose," and the second is don't forget the first rule. Yeah, it may sound a little bit too cliche, but this quote from Warren Buffett has become one of his most well-known aphorisms, as it captures his fundamental investment philosophy with both wit and clarity. Walk with us here, guys. If you pick 5 successful businesses to buy stocks and only 3 of them prove to be a success, would you say you failed, especially if the 2 losing stocks didn't significantly impact you? That's the big picture here. Always watch valuations carefully to reduce the likelihood of losing money. And before you tip your hats in a firm, always ask yourself the big question: what would Warren Buffett do in this situation? For instance, did you know that Warren Buffett never bet on weak companies with high debts and low prices? He doesn't even buy stocks that are driven mainly by hype. He always teaches that investors should only buy companies they understand very well and can genuinely see that will be profitable in the long run, like MasterCard, Coca-Cola, Visa, and Apple. It's been in his portfolio for years, and he's never going to stop betting on them because they're long-established, strong companies. They have low debt and very high profits. If you buy Apple or Coca-Cola right now, and even if you paid the price slightly on the high side, it's far less likely you'll lose money in the long run compared to following speculations on an unproven company. And this leads us perfectly to the Oracle of Omaha's next lesson, which is to always invest in the businesses you understand. Guys, you can throw shade at Warren Buffett all you want for being old school, but there is one thing he holds dear, and that's his belief that no investor should put his money on things he doesn't understand. And no, you don't have to have concrete knowledge of every single affair.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business.
In this context, understanding a business all boils down to grasping the economics of whatever business you want to invest in, and predicting what it will look like in 10 to 20 years from now. Of course, no one, not even Warren Buffett, can predict the future. Instead, he looks at the blueprints long enough to estimate his cash flows for the next couple of decades. And that's why he tends to shy away from cyclical companies and focuses on firms that have durable competitive advantages. Ever wondered why he bets on the likes of Apple so much? At the 2023 Berkshire Hathaway annual shareholders meeting, he boldly stated Apple is better than any company Berkshire owns.
Extraordinary. Probably we don't have anything like that we own 100% of, but we're very, very, very happy to have.
For Warren Buffett, Apple just isn't another business. He sees the unique place it holds in the lives of consumers as the key to understanding his investment. Most people would even give up their second car over their iPhones, which shows the incredible loyalty Apple commands. Such firms can never lose. In a nutshell, always weigh and analyze the business behind a stock. Try to focus on businesses you understand and of which you have some knowledge. This will help you assess where a company is going, not just where it's been and where it's at present. But moving on, have you ever wondered why Warren Buffett is a serial winner? It's because of his third rule. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Buffett sees investing as a game of psychology more than intellectual ability. And believe it or not, this approach will give you the full reward for your investments. It takes great businesses a long time to mature and compound, a critical path to Buffett's success. Guys, you don't need to constantly check stock quotes, prices, and valuations. It'll only give you headaches and anxiety and leave you open to making bad judgment calls. Buffett emphasizes the importance of readiness for stock price fluctuations, including downturns of 50% or more. Warren's fortune, built through holdings like American Express, Coca-Cola, Bank of America, Visa, and Apple, reflects his commitment to long-term investing. Each of the stocks in the Berkshire portfolio has been held and compounded for over 10 years. For instance, Buffett bought Coca-Cola in 1988 for $1.3 billion. And today, that same investment is worth over $24 billion, paying Buffett $700 million annually in dividends. Yeah, you heard that right. In a nutshell, always be in the right psychological position and think long-term instead of having a gambling mindset. Remember,
Stocks are safe for the long run, and they're very unsafe for tomorrow.
if you're not going to hold a stock for 10 years, you may as well not bother buying it. But in the same vein, this leads us to his next rule, which is always buying below intrinsic value. After all, the sole purpose of making an investment and putting money into something is to generate more money in the future, right? When it comes to financing and investing, intrinsic value refers to the actual worth of any asset or investment, independent of its current market price. Smart investors like Warren Buffett always find assets and stocks whose intrinsic value is much higher than the market price, because it's a clear suggestion that the stock is undervalued. But usually, a company's intrinsic value might be priced lower than its share value for two reasons. For one, if most investors believe that the company's future earnings or cash flows will be lower than previously expected, they may be willing to pay less for the company's shares, resulting in a lower share price compared to its intrinsic value. And secondly, due to macroeconomic factors like market fluctuations, economic conditions, and industry trends, the pricing of a company's shares sometimes leads to a divergence from its intrinsic value. But why should investors always buy below this value? To start with, when investors buy stocks below their intrinsic values, they position themselves for favorable risk-reward scenarios. If the market price is significantly lower than the intrinsic value, it allows investors to benefit from potential capital appreciation when the market corrects itself over time. And guess what? This approach from Warren Buffett perfectly aligns with the principles of value investing, emphasizing the importance of acquiring assets at a discount to their intrinsic worth. And don't even get us started about the margin of safety. Companies with good intrinsic value are almost always guaranteed to do well in any economic situation, thanks to their sustainable competitive advantages and efficient management. Remember what Warren Buffett said about Apple?
And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean,
It's one of the best companies in the world in terms of its strong intrinsic value, and that's why it's such an amazing stock to purchase. Consider the case of an investor, and let's call him Adam, who wisely bet on Apple Incorporated, inspired by investment legends like Warren Buffett. Adam focused on companies with enduring competitive advantages. Despite market fluctuations in several bear markets, he recognized Apple's robust fundamentals, a loyal customer base, a powerful brand, and innovative products. When faced with economic challenges, Adam remained steadfast, holding onto his Apple shares while others panicked. But hey, in the end, he won. The company's stocks kept soaring, and he kept winning and compounding his dividends while others were shaky. Before we go into rule number 5, always remember this golden rule. Ensure you're buying well below a stock's intrinsic value. If you're not sure, stay away. With that settled, rule number 5 is actually more of a psychological warning stemming from a classic Buffett quote. Be greedy when others are fearful, and fearful when others are greedy. Believe it or not, market reactions are frequently guided by emotions like excitement, greed, and fear. During bull markets, when optimism prevails, investors often succumb to excitement and greed. Witnessing others reap profits, they enthusiastically pour substantial investments into stocks. This collective behavior contributes to inflated market valuations and sometimes irrational exuberance. On the flip side, bear markets or periods of stock underperformance trigger fear among investors. Faced with declining portfolio values and a gloomy market outlook, fear prompts many to withdraw from stocks, exasperating the market downturn. Allow us to elaborate on this. Do you remember the emotional cycle that happened during the dot-com bubble of the late 1990s? During the bull market, investors were gripped by excitement and greed, pouring money into internet-related stocks. However, when the bubble burst, fear took hold, leading to a mass exodus as investors rushed to cut losses. Guys, Warren Buffett is telling us all to be aware of these psychological issues and act counterintuitively when necessary. Deviating from conventional behavior and investing in high-quality businesses during times of panic can yield exceptional returns. In 2008, amidst the financial crisis, Buffett capitalized on the fear in the banking sector, making substantial investments in Goldman Sachs and Bank of America. And given how 2024 is shaping up to be a make-it-or-break-it year for investors, being greedy when others are fearful may just be all we need. Remember when Warren Buffett said successful investing doesn't necessarily require a high IQ, but rather the right temperament? Being smart is good, and having the ability to remain calm and evaluate opportunities during turbulent times is one of the most crucial parts of being an investor. Let's be real though, golden opportunities often come once in a decade or two, or even a lifetime. And that's why we have to be patient and vigilant at all times, so that when they do arise, we'll be in the best position to act, and on a big scale.
Thing that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all.
Pause for a moment and picture the career of Warren Buffett. He's seen the dot-com crash, the global financial crisis, and the 2020 stock market crash. But guess what? Despite capitalizing on every opportunity, he still points out his biggest mistake by far, which was the mistakes of omission and not commission. The things I knew enough to do, they were within my circle of competence, and I was sucking my thumb.
I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it.
To put this principle into action, contemplate setting clear investing goals, be it initiating investments with a specific amount, delving into annual reports, or enhancing your knowledge through valuable stock market literature. Establishing a plan enhances the likelihood of seizing opportunities rather than just being aware of them. This rule might sound funny, but yeah, it's actually centered around cigars, or at least the logic of them, but still, it's rather simple. Just as someone without money might scour the streets for discarded cigars to enjoy a few puffs at no cost, investors seek out companies that are temporarily down but still hold intrinsic value. Cigar Butt investing is a strategy that involves seeking out companies that have been undervalued by the market and trading for less than their liquidation value. The plan here is to invest in these undervalued companies, observe their recovery, and subsequently sell them at a profit. But here's where things get interesting. Despite how this approach contrasts with value investing, where the focus is on identifying undervalued, high-quality companies for long-term investment, Warren Buffett loved this approach early in his career. In fact, he used it to generate some of the highest returns during his career. However, he has since moved away from this approach and now prefers buying and holding quality companies for the long term. In his 25-year review called Mistakes of the First 25 Years, Warren Buffett disclosed that while the cigar butt strategy was rewarding, buying businesses with such an approach was foolish unless you're a liquidator. Think of it this way. If you see an ant in your kitchen, it's almost certain that there are many of them. Similarly, companies undergoing liquidation typically face multiple challenges. Even if one issue is resolved, it's common for new challenges to emerge. The success of a cigar butt approach relies on a temporary surge in the share price of a company, which may not materialize or could take an extended period. Imagine acquiring shares of a company at $100 each and managing to retrieve $150 from selling them. This scenario is acceptable if the profit is realized in a shorter time frame. However, if it takes 10 years to recover the money, wouldn't you say the returns were poor? If so, why bother?